You're new to this, I get it. It feels like there's a million different assets to trade. Don't you just wish someone would come along and tell you exactly what to pick so you can escape analysis paralysis? Today, I'm giving you a cheat code to finding the perfect Forex pair or index to trade, and we'll also talk about how many instruments you should be keeping an eye on. One of the questions I see new traders ask the most is, which pair is best? Or which pair is going to make me the most money? But you're stuck because when you ask Google how many Forex pairs there are, it says 128. So let's start to narrow that down by a few. You're looking for two main factors really, liquidity and volatility. Liquidity in Forex trading refers to the ease with which a currency pair can be bought or sold. It's determined by the number of buyers and sellers participating in the market for that pair, as well as the size of the trades that they're placing. Simply put, the more active orders a given market has, the more liquid it's considered to be. And the more liquid a market is, the less erratic price should be, in theory. Liquidity is important for Forex traders because it allows us to enter and exit trades quickly and easily and without having to worry about immediate significant price movements. This is often most obvious when looking at spreads. Liquid assets will have tighter spreads than illiquid assets, thus making entering and exiting your trades at or near your preferred price easier. Now that we have a little bit of a grasp on liquidity, let's talk volatility. Volatility in Forex trading refers to the degree to which the price of a currency pair can move over a given period of time. The higher the volatility, the more you can expect it to behave unpredictably. That being said, you don't want zero volatility in your asset though, as everyone agreeing on price just means it would flatline. There's a comfortable sweet spot for volatility where it feels like price action is just predictable enough to capitalize on, and that's when you want to be trading. Now, I could go into techniques to help you keep an eye on liquidity or talk about indicators that help you track volatility levels, but let's just get to that cheat code, right? To find out what pair or instrument you should trade, first let's figure out what Forex session your trading window's in. I left a link down in the description for a great tool to help you figure this out. Go do that, then come back. Now that you know what Forex trading session you trade during, on to some suggestions. If you trade during the Tokyo session, test your strategy on these assets: UJ, AU, AJ, and the Nikkei. If you trade during London session, give these instruments a go: EU, GU, UF, FTSE, and the DAX. If you're a New York session trader, you'll want to try these out: UC, EU, GU, AU, UJ, UF, NASDAQ, or the S&P 500. You may have noticed by the end, the suggestions for each session revolved around instruments that were more localized to that region or time zone. That's basically it. That's the cheat code. If you trade during Tokyo session, for example, find the Aussie or JPY pair with the right combination of win rate and returns for your risk profile. Throw in the US dollar because it's the world reserve currency and by definition very liquid, and you're well on your way. Lastly, if you're looking for something slightly different no matter what time you trade, check out gold or oil. Remember to test out your strategy again and again before taking it live. Build that confidence in your strategy and in your pair. I left links in the description for a TradingView watch list for each session. Now, just because each watch list has multiple pairs and indices doesn't mean you should actually trade or even look at multiple instruments per day. In fact, less can often be more. If you're entering on the 1 or 5 minute timeframes, I'd highly encourage you to really only look at one pair index during your trading session. Maybe a second if you notice that your primary is consolidating, but only after building out a lot of data and thus confidence in it. I wouldn't recommend taking a look at more than one pair every day unless you start taking your entries up on the 15-minute or higher. And if you're the type of person who enters on the hourly time frame or higher, just go ahead and keep an eye on as many pairs as you feel comfortable with.